It's like that little guy down there in the corner. You need the right tools for the right job. I don't know if you've tried to, hammer a nail in with a screwdriver. It doesn't really work so well. You don't have the right tools, and then you get the right tool. It's like, that took like a moment. It was so easy. And so let's start with this foundational principle. Infinite banking is never, ever about the policy. It's about the person and then the process. The wealth acceleration is going to be the person looking to create passive income, because we understand, I believe, like myself, you're all here because we want to control our money, and we want our money, our little friend, to go out and do work for us. So how many of you, as we head into December, as we're in December now, find yourselves reflecting and wondering, did I move forward financially, or did I just stay busy? Or maybe, did I get any closer to actually taking control of my financial life? If that's you, you're in exactly the right place. And I want to commend each and every one of you for showing up again today. This is a season where most people are checked out. They've mailed it in, and you're choosing to lean in. And that tells me a lot about who you are and what you want. And today, you're going to walk away with a crystal clear understanding of how the infinite banking policies are actually engineered, the truth about premiums versus policy loans, they're not the same thing, and how to determine your ideal funding level, not someone else's, and what really drives the long-term cash value growth, and including why it really accelerates the longer you go. I'll never forget when one of my clients came to me years ago now, 3 years ago, thinking, Jason, I've been practicing infinite banking for 11 years. And what we found out as we dug in is he was sold a product. He had no process. He had no real purpose with it. He just thought that he had something that was going to help him now, and he's got a bunch of kids. And so when we sat down and we looked at their income, their goals, what season they're in, what was possible, everything clicked for this individual. And that moment taught me this. Infinite banking isn't about having a policy. It's about building your system. So today we're going to kick off our December IBC FAQ Masterclass. That's a mouthful. Say that 5 times. With the 4 biggest questions we received from clients in 2025. That's what we're covering today. And whether they're just learning about infinite banking, or like many of you, they already have one or more policies in place. So let me share my screen here. And so, like I was saying, today we're going to cover the 4 most important questions I hear from both new and the seasoned infinite bankers. And before we dive in, I want you to know something. I'm going to reveal one part of your policy that 95% of people misunderstand. And it's the reason most people never maximize their systems. They have systems, but they're not optimally efficient. So keep listening for that. I'm going to cover that in a few minutes. And here's the biggest question, right? Number 1, how is my policy designed, and why does design matter so much? And it's like that little guy down there in the corner. You need the right tools for the right job. I don't know if you've tried to, hammer a nail in with a screwdriver. It doesn't really work so well. You don't have the right tools, and then you get the right tool. It's like, that took like a moment. It was so easy. And so let's start with this foundational principle. Infinite banking is never, ever about the policy. It's about the person and then the process. And so, as you can see on this slide, focusing on the person is a way we design your system depending on 5 key factors. The first, well, these aren't in any particular order, but probably your age makes a difference. Not in terms of cash value, but just where you are on the journey and how that impacts things. Your existing insurance, your income is a big factor, your savings rate and liquidity, like are you saving and where are you saving it? And then most importantly, this is number 1, most importantly is your goal. Why are you doing this? And before the end of the webinar, I'm going to show you 2 simple questions that you can ask yourself to know instantly if your policy is designed correctly, or if it needs some adjusting, or maybe it needs an additional warehouse of wealth. But first, let me show you 3 real examples of policy design solving 3 completely different problems for 3 different people, so this makes sense. So number 1 is going to be debt elimination. With our debt right now in the US is what, $1.2 trillion dollars plus. It's the highest it's ever been. Congratulations, America, right? But not you guys. Again, but I like congratulating everyone who's following the status quo. They're not daring to think differently. They just keep doing the same thing. They're out spending what they make. And so they end up with a massive amount of debt. So, when someone comes in with debt elimination, and that's their number one priority, they have told me, we've had the conversation, we need to design what they're looking to do. Like maybe they have no dumping because they're not saving. So first we maybe find some leakage. We shut that down. And then we're going to design it so we have 70 to 75% going towards the paid up additions. Remember, that is the driver, that is the fire, the fuel that is going to help someone accelerate their early cash value and the growth coming up. Now, there is trade-offs to this, but what we're trying to do, remember, if we're focused on what is the main problem, keeping the main thing is this helps stop the bleeding fast. We want to get that Band-Aid on. Or I was talking to someone yesterday who puts the Band-Aids on that basically are like wet vacs and it seals the wound shut. That's what he does for a living, is sell those things in sales, right? And this is the purpose of this: debt elimination, recapturing interest that is going to them over there. There's no dump in for this person. And I'm going to show how the control and the guarantees, by changing this one thing, and show you a real example of this, of someone who's just gotten started, bought a second property, and looked at how much she was going to pay them, them being the banks, how much interest she would pay on her new dream retirement home, someone that had really good financial habits but wasn't saving other than to eliminate debt and to pay off mortgages. So we showed her, hey, look, switch one thing and everything's going to change. And so I'm going to show you, I've had 4 or 5 of these in the last month. So I'm going to show you that one in a bit. And then number 2 is going to be wealth acceleration. These are my investors. These are the people that have no debts. Because remember, your debts are a guaranteed asset. Just want to anchor that in. That might be new for some of you, but debt equals guaranteed asset. There's no risk, right? Any investment doesn't have a lid on it. So therefore, things can happen. Money might not all come back, or it might come back slower than you expected. We've all been there. If you're an investor, I guarantee that you have been there in that situation. So you know what I'm saying. Number 2 is, if we're solving for the problem of making major purchases, buying new vehicles, buying vehicles for our kids, maybe getting a second property, maybe updating some outdated, trimmings and fixings in our house, whether it's kitchens or porches or back patios or whatever it might be. And number 3, the second one here is the wealth acceleration is going to be the person looking to create passive income. Because we understand, like, I believe, like myself, you're all here because we want to control our money, and we want our money, our little friend, to go out and do work for us. The second one is when you do have liquidity, you have lazy cash that might be wrapped up in a savings or a money market, or maybe it's an old retirement account, but it's just sitting there. You don't really know what it's doing. And if you don't know what it's doing, guess what? It's probably being lazy. It's like when the house gets quiet and you have kids, you're like, either they're doing something wrong or they fell asleep, right? So the second one is we're going to do something that's going to build over time. I use an example here of 20,000 a year and an $80,000 dump in. So you're putting 100 grand in on day one, and you're still going to have a manageable floor of about $10,000. But now you have the ability to accelerate that in years 2 and on. And you're going to hit efficiency point way sooner. And you're going to have somewhere between 85 and 90+% of the capital available in the first 30 days. This is perfect if you know, hey, I have an opportunity to purchase a business, to do hard money lending, to do real estate, whatever it is that you're into, to go into crypto. And now you want the and asset. So you're building something that's going to guarantee to grow, and you're going to make a spread in the middle like the banks do. So this is probably the second most common problem that we're solving for. And then the third one, this one doesn't happen a lot when it's just multi-generational legacy, but let me talk about this one for a moment because it might spark some ideas for some of you. So I'm working with a couple individuals that I've been helping over the years, and by now they started with one policy, and now they have One person has three, one has five, one has six. Just kind of depends on how many kids, spouses, insurable interest, and how well they're doing by taking back control of their money. But now they're to the point where they're like, I already know my kids are going to be left generational legacy. So we got to set up the vision, the values. What does that look like down the line? But here's a really cool thing that they're doing. They're saying, you know what? My mom or my dad is still healthy. They're still earning a little bit of income. And I want to not only help them in retirement, but I want the payout when they die. And you might say, whoa, that's a little weird. But think about it. If you're generation one and you could put a policy forcing or creating out of thin air long-term growth, long-term success, more coming into your family later for something that's inevitable, that's a blessing. And so that's something we're going to put the majority towards base. The majority of the base. I just did an interesting one today, helping someone. It's going to do a dump in. It's mostly for legacy. She's going to want some cash value. But based on all the parameters, we put like 90% towards the base. Some you'll put 100% towards the base and maybe do a dump in. And so that's going to be the rare case, but that's going to be what's optimized for long-term growth, or it's going to grow later in its legacy first. Does that make sense? We got a lot of amens. You guys are excited. I love it. And this is perfect if you've already created your banking system. You're a good banker. You're actually a wealth creator at this point. Maybe you're approaching the role of being an infinite banker. And now you're like, oh, if I can get more policies out here, like Devin on our team did this with his parents. So this is something that if you haven't thought about it, you could probably think about this in the future. And then next, we're going to go to the part, I promised this earlier, the part that 95% of people misunderstand. Oh, first, forgot to add this slide. Just did this before this, but this is what I was talking about. Look, if this individual who just became a banker practiced their strategy, if you can see the slide, you see on their strategy, meaning no strategy, the bank strategy, their strategy. When I mean there, I mean the banks, Wall Street, and the government. I mean the people out there who don't have our best interest at heart. Make sense? And so no strategy takes another 14 years to pay off the debt, and they're going to pay $143,000 of extra to the bank on top of the on top of the 240 or 250 that the mortgage was. That's a lot of extra money, right? You got a mortgage for 200 and some thousand, you're going to pay an extra 143,000. That's a lot. And so when we just change where her savings was going, before it was just going in velocity, just throwing it in the HELOC, trying to pay off the debt faster. And what I showed her is, look, when you just use infinite banking, now it's going to take you 61 months to eliminate the third-party debt. That means from the bank, another 69 months to pay yourself back. So you're still saving 35 months overall, 3 years overall. And at the end, you're going to save $75,000 in interest that you would have paid to them, right? That 75 grand's coming back to you. And you're going to have $983,000 of death benefit and almost 400 grand in cash value. What can you do with 400 grand in cash value? Do you think opportunities might find you? So there's just a couple. Now we're going to go into that question I was saying, the 95% that's misunderstood, right? And most people think the base premium, and I realized doing this with these 4 topics, these 4 questions, these could all be a 30 to 40 minute class individually. But I want to hit this high level for all of you. What are the most common mistakes or problems that people are sharing with our team, with Patty, myself, and our team? And again, here's the part that 95% of people misunderstand. Most people think that the base premium is extra and not as important as the PUA rider. That's why we have some groups out there designing, a very, very, very little base, because they have no idea how each one has a specific job and that each one drives the growth of the system. And the base is what is strengthening the MEC limit. It's growing long-term. It's protecting the policy. And it's also allowing larger dump-ins, and in some cases, additional paid-up additions, which I teach a lot of you. And the paid-up additions, remember, that's the rocket boosters. That is what is going to put this thing into orbit quickly. It's the big difference between a regular whole life off the shelf, right, from your broke-ass brother-in-law, and what we do when we're designing these specially engineered high early cash value with a mutually owned dividend paying company for you. And the PUAs are what accelerates the early cash value for the banking access. And when you understand this one thing, this is how everything is changing. Because now you understand that if you want your cake and eat it too, if you want this to happen over the long time, you start seeing why the base is actually important, why it's okay to give up a little bit of access in years 1 and 2. And sometimes you have to give up hardly any, but you can still have a large enough base. So in years 2, 3, 4, and on, it gets better and better and better. And that makes years 11 and on even better, which is something we're going to talk about here. Hey, before we jump into the second most asked question of 2025, take a moment and smash some stuff, ring some stuff, subscribe to some stuff. Yeah, that's right, a little crazy. Smash, ring, subscribe, invite more people. This is Infinite Banking, folks. This is the Infinite Banking Buzz, and it's a big buzz. Bring everyone here. This message needs to get out. America is suffering, and there's no need for it. When we bring it back to the you and me level, that is banking. When we take the power away from them and bring it back to us, we will continue to accelerate as a people, and you will feel so much different once you have control and certainty. So again, I really appreciate that you're smashing, you're liking, you're subscribing, spreading the message, helping us get this message out there. Thank you. And let's go. And here's a second. We've only been at one question so far. You believe that? One question. I'll start rolling it a little faster here. I don't want to keep you all too long today. But the second one is, Jason, what's the difference between paying premiums and paying back a policy loan? Because a lot of times we think, hey, we're going to start our banking system. We're doing this because we don't like loans. No, it's not that you don't like loans. You don't like having someone else in control of the loans. So let's make this really clear, crystal clear. Premium payments are here and loan repayments are here. They are two separate things. The premiums are the number 2 rule in becoming your own banker, you know, in the greatest book that's ever been written about this stuff. And that is that the premiums are going to build the system. The loan repayment, that's the 3rd rule, right? Don't steal the peas, as Nelson would say. You know, don't go to your store, don't go to your gym, don't go to your restaurant and take stuff for free because you're stealing. So you want to have a loan repayment plan. Does that make sense to everyone? I mean, it's super simple, but we get asked this all the time because I think there's a fear. I was trying to think, why do people ask this question so often? And I think it's because there's a fear or a misunderstanding that, listen, if you had like we did, $114,000 of bad debt, $3,300 a month leaving the family, just every month, it was like clockwork, same days, money's going out to the family of Ford, family of Hyundai, water filtration system, the debt consolidation. That's right, folks. I've screwed up a lot. I made a lot of mistakes. And then that money is now all flowing back into the Sipples. But there was a period when I looked at Patty during one of our money meetings and I said, oh my God, we have over 120 or 30 or $40,000 of debt. I was like, I thought we were out of debt. And I got panicked. And she goes, Jason, she had to she shook me. She's like, Jason, that's the debt to the Sipple family banking system. And we're repaying it. We just happen to have that money out working for us now and coming back in passively. Our little men are out there working for us. And I was like, I cussed. I was like, holy bleep. That's amazing. That's amazing. So this is a really important thing to understand. They're not the same thing, but they both have their roles. One's building the system, one's refilling the system. One builds, loan repayments refill. And you can refill on your own terms, which we're going to go over after we go through the premium capitalizing the system. So this is what your premiums capitalizing the system are doing. Like every premium you're putting in is going to grow the cash value. It's going to grow the death benefit. It's going to improve the dividends. It's going to give the MEC limit more strength. It's going to give more future growth. And it's going to be that opportunity fund size. Like you're building an opportunity fund, and over time, that's going to get bigger and bigger and bigger. This is how you are capitalizing your system. It's not a bill. This is your ability to do something where all of a sudden, when you're 4, 5, 6 years in, you're going to look and be like, oh my God, 11 years in, you'll be like, holy cow. From day to day, this thing has grown so much. And if you haven't gotten there yet, just like I say a lot, hold the disbelief until you get there. Cause it's wow, folks. I mean, we're 3 years into our policies and they're already starting to show signs of really picking up momentum. And again, it's not a bill. And I'm going to show you the one mistake that most people make when repaying the policy loans in just a few minutes. And it's probably not what you think, right? So let's jump into the policy loans a little bit. And so this is using your system. And I talk about this on all my calls. So if you've had this call with me, you've already heard this. And if you forgot, it's okay. That's what we're here for. So if you believe what I believe, the wealthy have more choices. Fair statement? Is that a fair statement? If I could get a yes in the chat, if you believe that's fair, then let's go through. There we go. True. The wealthy have more choices. So again, when you transfer, like think of bad debt as someone a pickpocket. Like every time you go reach in your pockets, they've stolen all the money. Or think about like you're at the playground and you're on a seesaw and you're on the bottom and you got somebody, or you're on the top and you got somebody on the bottom who outweighs you by 300 or 400 pounds. There's no way you're getting unless you jump, right? You feel a little desperate. Well, we want to change that environment when we use a policy loan. So we're shifting over time the environment, right? We're going to change it so you have a tailwind. And then you decide how you're going to pay back your policy loan. You can either do it in three ways. It's either structured, where you do the same exact things. And this is what I recommend actually. When you're able, like if you're making a major purchase, look at the market and pay yourself more than the market would pay. So you're paying the loan back faster and plenishing your system. It's a structured payment over time. It's exactly what the banks are doing, how the banks want their money for in the loans, car loans, personal lines of credit, or anything else that you're borrowing from the bank. An unstructured repayment means that you can pay as much or as little as you want when you want. So for some of you that get big bonuses, you might have the money out working, a bonus comes in, and you might just replenish that because guess what? You're scrunching down, right, the margin of what the actual interest going to be paid on that loan from your system is, which is actually from the mutually owned company, your partner. And that gives you a bigger spread on what the money is out there already making you. Next, you can do an interest only repayment. That's what we're doing when we're keeping our money working because we're really liking the investment we're in. So we are keeping that money in there. It's out there working for us. And then we're going to roll it over to the next year and have it keep producing income, right? Our money's going to work for us while we're sleeping. And I'm only paying the simple interest. And for us right now, that's about, of all the money coming in with all the interest owed on our 4 policy loans, it's about 2 months worth of what we're earning. So I get 10 months in the green and 2 months in the red where I'm paying to keep everything healthy. And the number one mistake that I'm seeing, I told you I'd get to this, is people stop paying the premium deposits because they think the loan repayment is actually replacing the premium. Let that sink in. Like I've seen this and I don't understand it, but it comes up often enough. I wanted to bring it up here. So the premiums, again, are growing your system. They're capitalizing your system. They're doing the second law according to Nelson. And being an honest banker is a separate part of the system, right? It's like dribbling and shooting. They're two separate things. Like if you start just walking with the ball, you're traveling, right? When you're dribbling and you pull up and hit a jump shot, that's executing two different things. You got to the spot, you took the shot, you made it or missed, but at least you're taking the shot. So with premiums, that's the capitalization, the premium deposits you're making into the system. The loan repayments is what I just talked about in the previous slide, where you need to have a plan and a plan to replenish your system. And that's going to restore the availability. And you got to treat them as separate. And when you do that, your system will flourish. That's when your system flourishes. And so here's the third most asked question I get. What's a good funding level for my goals? And I hear some folks, some of my peers, and I've talked to them about it, saying, hey, it's 10x your age. And even though that's a really easy answer, hey, I'm 40, it's going to be $400 a month. I'm 50, it's 500. But I'm not saying that. That actually worries me because I have had 3,500 plus calls. And it's called specially engineered for each person for a reason. Not one of my calls is exactly like the other. Sometimes they're similar because there's only really 4 problems we're solving. But for each person, there's a slew of variables that we need to go through first. And the first one is, and you guys probably know it, what do you think the first one is? That's right. It's what's the goal? What brings you here? How can I serve you? And then what we're working with in terms of, again, your age, your habits, your income, your savings, the lazy money, and your funding level is going to be determined by your personal financial habits, the efficiency of your system that's existing, or if you need to grow one, the cash value or flow flexibility that you have, the growth timeline, like when do you need the money? Immediately, next year, 2 years? What does it look like over time? Like, where are you today? Where do you want to be in 10 years? And the simple formula that I give everybody, and I kind of say, we don't do a lot of bowling in our family. We're actually, I think I bowled maybe 110 last time. Not very good. I think Diego beat me for the first time ever. So kudos to D. But think about having the lane bumpers when you go to a kid's birthday party. They put them there so the kids can all feel good about themselves. They can roll the ball wherever. And it goes bing, 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 and it knocks down a bunch of pins, right? No matter what. So that's the parameters I want to give everyone for this question. What's the optimal funding level? A, what's your goal? And when do you want to accomplish it by? That's where we start. And then we go to all of the things that determine how much you can do. But I usually say, listen, depending on the mutual company, like our partners, right? Because we're the ones in the middle mentoring, putting you together with one of these partners in the hopes that they want to partner with you when we have everyone thrive. And so with these mutually owned dividend paying companies, when we're looking at the partnerships, they're going to allow somewhere between 20 and 25% of your annual gross income to go into the policy on an annual basis. Remember, you have multiple ways you can pay your policy premiums, your deposits, but the max. So if you make, for example, if you make 100,000, depending on the carrier, you're going to be able to put somewhere between 20 and 25,000 annually is the most you can do on an annual basis. You can overfund it still, but annually, that's the most. The minimum is just following logic, right? Is following the first law of wealth. And I actually say that anybody that's not following the first law of wealth, they should keep on practice. Practice, 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 like Allen Iverson would say, right? Practice. What do you mean? You're talking about practice? Yeah. The first law of wealth, pay yourself first. Richest man in Babylon, pay yourself at least 10%. 10% of your gross income should be automated. You should never even know that money is there for you to even think about spending it. That's the minimum. Ideally, you're looking at that 20 to 25%. Or if you have more, that's when we start talking about other insurable interests. Again, if you make 100K, that's somewhere between 10,000 a year and 20 to 25,000. If you do make 250,000, you do the math. If you make 50,000, you do the math. It's easy. That gives us a basis for the conversation to help you reach your goals. That means you're actually capitalizing the system and you're thinking long term. And so if that's new for everyone, if you've worked with me before, you know that I'm talking about that all the time. But this is probably the third and the most misunderstood piece of this is what's the optimal level? And the answer is I don't know until I know what you care about and what you want, right? What you want. In a few minutes, I'm going to share with you another real example that proves why your policy gets more and more efficient every single year and why year 11 is such a massive milestone, and this is really to do with the power of time. And so the next most asked question I get is how fast does the cash value growth and what determines it? And a lot of the misconception is, well, hey, there's no cash value because of the commissions paid, or because life insurance is super expensive, or it's really expensive to get life insurance. And it is not any of those things and all of those things simultaneously. What's really determining your long-term cash growth is going to be a combination of things. What is the guaranteed interest rate of that insurance company? That means the worst things could ever be. How long historically has this company paid out dividends and what are the dividends average? With our 5 carriers, our preferred carriers that we work with all the time, you're looking at all of them being profitable every year, well over 100 years, 119, 137, 148, 160. and they've never missed a dividend payment. That's wildly, wildly impressive, is it not? But now that is going to affect the growth, the dividend amount. And what are we using the dividend for? Is it buying more paid up additions, putting more fuel into the system, or using it for something else? I get some people saying, hey, we're going to get to year like 12 or 13 or 14, and now my dividends are going to pay my policy premium. And I always say, yes, but let's think about that. Let's put our thinking hats on for a moment. If that's the case, and that far into the policy, you're putting $1 in and you're getting $1.50 back, why would you use your dividend that could buy more paid up additions, that could give you more cash value, that can give you more legacy, right? All the things it does. It keeps accelerating the system, your banking system. Why wouldn't you just find a way to pay that money in that you've earned, or maybe you even borrowed from somebody else and promise to give them back 10% in a month? We got to think like the bankers. We want to continue capitalizing our systems as long as possible. Yes, if you're in a pinch, your dividend could pay the premiums. But if you're looking for the most optimal, which is what we're talking about here today, we want those dividends buying more paid up additions. We want the uninterrupted compound interest, and that the PUAs that you're buying is adding more and more fuel every year. And in some cases, you're able to even go back in and add more, PUAs after the policy's in force. Remember how I told you year 11's kind of the turning point? And this is a story I tell at the time. And I found that picture of Einstein and, the eighth wonder of the world, uninterrupted compound interest. And think about this, everyone. If you're going to be in a partnership, and I tell this story fairly often, so we're gonna pick Rodney. Rodney, you and I are gonna be partners. And yes, we can definitely do that. If you want to mail me what you got, we can go over it. But in year 11, why is that the turning point? Well, think about this. We're going into a partnership. We're starting a new business. Now, we've been told that this business is going to get better and better every single year. But when we start in year 1, we put in equal 50-50 share. And year 1, after paying all the overhead, all of the payroll, all of everything else, we have 60% liquid. We're like, okay, it makes sense. We learned a lot this year, had a lot of growing pains, new business, but at least we're doing all right. Year 2, same amount of money going in, and now we have 70%. So Rodney and we're feeling pretty good about this, right, Rodney? We're like, hey, we just grew by 10%. That feels a little bit better as far as our liquid cash reserves that we need to do stuff with. In year 3, we put the same amount in, and now we have like 85 to 90%. We're starting to get pretty excited. We're almost in the black. Year 4, now we're at 90 to 95%, or maybe we're even dollar for dollar. So now we're like, oh, I can feel it coming. The momentum is coming. The thing's chugging along. We're about to be really profitable. And year 5, maybe year 6, we're putting $1 in and we're getting more than $1 back. And it keeps getting better every single year, no matter what. As long as we keep capitalizing it, it keeps growing. It is a forever chart going this way, like this. It doesn't look like the market where it's up and down. It is just going in one direction, from the bottom left to the top right, forever and ever. If you knew that this worked the same way every single time, then how many of you would want, or how many of these would you want? How many of these policies or these businesses would you want? You'd probably answering, I hope you're answering, as many as I can have. And how big would you want them to be? And hopefully it's as big as possible, because look what happens in year 11 a lot of the times. Sometimes it's even more than this, sometimes a little less, right? They're all specially engineered. But this is when you're getting 100% or more cash on cash return in most cases. And this is because the uninterrupted compounding is becoming exponential. So for example, like if you're putting in $4,000 or $8,000 in year 11, that means you either have 8,000 or 16,000 new dollars, right? You're putting in $1. Actually, if you're putting in 4, you have over 4,000 new dollars, right? You're putting in $1, you're getting 2, but half of it is tax-free growth. That's the cash on cash return. Now, I had another slide. I don't know where it went, so I'm going to just talk about it, but you can't see it. But there's 2 questions that tells you if your policy is designed correctly. And I know, Ronnie, we're going to talk about this. Anyone else, happy to talk about that. It's one is a design around your current season of life and your primary financial goals. If yes, awesome. If no, you might need some adjustment. And the second question is, does my policy structure give me flexibility and not pressure? You should have that manageable floor, that meaningful ceiling. If it feels like a bill, you're either thinking about it wrong or perhaps it's not set up optimally. If it feels like an opportunity, then it's all right. So let's recap what we covered today. Why policy design is personal and not a one size fits all. Why the premiums capitalizing the system and the loan repayments just refill it. How they're completely different things. They are two different parts of the same system. And if you want it to work well, you have to do both. And how do you shift your mindset to fund like a banker and no longer think like a consumer? And then we also talked about what actually drives the cash value, especially the acceleration that kicks in around year 4 and compounds for decades, forever, actually, till you graduate. And remember what I said earlier, infinite banking isn't about the policy. It's about your system, your life, your goals. And today might have been the first time that clicked for you. And if you came here looking for clarity, we walked through the 4 most asked questions in 2025 regarding IBC. And now you're equipped to make smart, confident decisions about your own banking system. And if something just clicked today, if you had that, wait a second, this is too good to be true, or even if you just want a second look at your policy structure, then scan the QR code, book the call with me. Let's make sure, take action today, because you're at a path through or a crossroads where you can either go left or go right, keep learning, or take action. Action will accelerate your life. Let's make sure your system is truly engineered around your life. So thank you for showing up. Thank you for thinking differently. And thank you for taking a step closer to financial sovereignty. So again, smash, ring the bell, subscribe to the channel. Let's spread this message to everyone who's out there. I'll see you in this next video. We're going to keep diving deeper into this really earth-changing system that's super simple and requires one change. So I'll see you in the next video. God bless. Thank you for being here. I am so grateful for you giving me your most valuable asset, your time and your attention. In an attention economy, this is the most powerful thing you could share with me. And I hope that you found that nugget that you're looking for that launches you towards financial sovereignty. So go ahead, book the call with me, scan the QR code, click the link, go to my website, find a way to come talk to me, come prepared, and we will solve all your problems now and the future. Again, thank you so much. God bless.